Hello everyone, this is a review example for your fourth comprehensive assignment in managerial accounting. In this example, we are going to be Cleanmore Appliance. We are a brand new publicly traded manufacturer of household appliances. We are beginning operations and keeping books for the first quarter of the year 2023. We have the description on this tab right here of all the different transactions that Cleanmore took on during the period. We need to record a journal entry for each of these transactions, and ultimately we're going to go through the accounting cycle and make our T account balances, make a trial balance, and from that trial balance we are going to make our three main financial statements. If you can see from the tabs on the bottom, they are the income statement, the statement of RE, and the balance sheet. Cleanmore is just going into operations. They probably need some money, so we're going to start these journal entries with a few that are going to help them raise funds. And in the first entry on January 1st, before we can even begin to raise funds, our board of directors needs to say that it is okay to issue equity to sell a part of the company. So Cleanmore Appliances board of directors is going to authorize 2 million shares of $1 par common stock and 250,000 shares of $25 par 6% preferred stock. Well, what's going on here? Is anything really changing on our books? And the answer to that is no. The board of directors is saying, yeah, you can issue these shares at any point in the future without our approval. This is like the max that we're going to allow you to sell into the marketplace. But we're not actually selling them at this point in time. We're not getting cash. No one is getting ownership of our company. Journal entries, by their nature, are used to change the financial position of your company on your books, and nothing in our financial position is really changing here. So for any authorization entry, there's never an entry required. I would like you to either type in no entry required in the description, so I know that you understand that authorization entries don't require formal journal entries to put them onto your books. Or if you want to be a little thorough, you can record a memorandum. And to do so, you type memo in the date box, and then anything that you want on the lines or in the description or whatever that denotes the fact that the company now has new authorized shares. So I'm going to put shares authorized on the first line, the colon afterwards, and then just something so we know what it is. I'm going to say 2,000 shares of common, and down here I'll write 250,000 shares of preferred. Again, this isn't an actual entry. It's not going to change the balance of your books. But as you're going back through the books, if somebody says to you, hey, how many shares do we currently have that are authorized that we haven't issued? You have a point of reference to find somewhere in your journal and say, okay, on this date we had this amount of shares of common authorized. We hadn't issued any of them, and you can use that to do some calculations to figure out how many shares you have remaining that have been authorized that are unissued. But this authorization isn't going to help us raise money. We're going to do that right here on the other January 1st entry. We're going to issue 400,000 shares of our $1 par common stock at a market price of 10. Par, one more time, is the minimum value that you can issue shares for, but that doesn't mean you have to issue at the minimum. And if we're trying to maximize the amount of cash that we bring in from issuing shares, if we can, we're going to want to sell at a market price well above our par value, which Cleanmore on January 1st is doing. The entry to issue shares of stock, be it common or preferred, at a price that is above par is always the same. You're going to have one debit. It is going to be to cash. And you've got two credits. One accounts for the par value of the shares preferred. So I'm going to call this common stock $1 par. And the other entry, the other account used here, I should say, accounts for the amount that your now owners, your shareholders, paid in excess of that par value when they acquired ownership. That is your paid in capital in excess of par account, which I abbreviate because that's way too long to type, to PIC. So we have a paid in capital account for our common stock. To find the value of your cash being received, that's going to be the number of shares that you've issued times the market price that you're issuing them at. We are issuing 400,000 shares. We are doing so at $10 per share. That is $4 million. We're raising $4 million in cash. Our two credits are going to separate that into the portion of that $4 million that came from the par value of the stock and the portion of that $4 million that was paid in excess of par value. So for our first credit, the amount that goes to common stock, that's par value. So what we're going to do is we're going to take our 400,000 shares. We're going to type NSL equals 400,000 and multiply it by the par value, cooperate, of our shares, which is $1. So 400,000 of that 4 million is attributable to the par value of the common stock that we just issued, which means we know debits equal credits. A little subtraction here says that the amount that's paid in excess of par is 3.6 million. Well, is there a way you can prove that mathematically? And there is, because that number is going to be equal to the amount of shares that you're issuing times the difference between your market price and your par value. So equals 400,000 times 10, the issue price, minus 1, in parentheses, our par price. If you're going to use that formula, you absolutely have to put the difference, the difference between your market price and your issue price in parentheses. If you don't, it's going to multiply the 10 by the 400,000 first and then subtract 1 out at the time, and you're going to get a number in the billions. That's not what you want, because you know your debits have to equal your credits. So if they don't, you put that in, recheck your formula. But here we do. We got 4 million on the debit side, 4 million on the credit side. We are good to go. All we need is a description. Our description can say that we issued shares of common above par. Next up, on January 2nd, we're going to issue our other type of stock, which is our preferred shares. We are issuing 50,000 shares of our $25 par, 6% preferred stock. Again, trying to maximize the amount of cash that we bring in, the amount of capital we have to work with, by issuing at a price above par. We think we can sell these for 30. We're going to sell them for 30. The setup of the entry is exactly the same as above, except now this isn't common stock, this is preferred stock. So you just change the words. We have a debit to cash, a credit to preferred stock. It's possible you have the same class of stock, common or preferred, with different pars, so it's good form to put in the par value that you're working with, in this case $25 par, and another credit to our paid in capital in excess of par account for our preferred stock, which I'm going to shorten to pick preferred. Math is exactly the same as well. The amount of cash you receive is equal to the amount of shares you're issuing, 50,000, times the market price you are issuing those shares at, which is 30, comes out to 1.5 million. Separate that with two credits into the portion of that that is attributable to the par value of that stock and the portion which your owners paid in excess of the par value. So for preferred stock, we're going to have a credit which is equal to the 50,000 shares that we are issuing times the par value of those shares. This is $25 par preferred stock. So 1 1/4, if you will, $1,250,000 of that 1.5 million can be attributed to the par value of stock. Math tells us, therefore, that our pick preferred, that our investors paid $250,000 more than par value in order to acquire the stock. Let's prove it mathematically by typing in equals the 50,000 that we had times the difference between the price that we issued for, our market price, and the par value. 30 minus 25. Again, in parentheses, they're paying an extra $5 per share for each of those 50,000 shares, and 50,000 times that $5 difference is the $250,000 that we need. So their debits equal our credits. We're good to go on that entry. All we got to do is write that we issued shares of preferred above par. Companies do rounds of funding. Like sometimes they'll issue shares, they'll wait and see how the market reacts to the price of their stock, and then they'll issue more shares. It's uncommon that all authorized shares, like the 2 million that were authorized above, will be sold at once. Most times, to maximize the amount of money that you can make, you'll sit there and wait around. If you believe that the market for your shares, the price of those shares on the open market is going to go up, it would be the best of you to wait it out and sell them later on when the price goes up. We have Queenmore here taking the unusual stance of selling more shares a day later when their price went up. It's not realistic really to issue a round of shares and then issue another round of shares the next day. What I'm really looking to see that you understand that the setup of it is always the same. You're always going to have cash coming in, you're always going to have to account for the amount that's going towards par and the amount that's in excess. But for this entry, because we are issuing more common shares, just like we did in this entry, the accounts and everything are going to be exactly the same. If you want to save yourself a little bit of time, if you have an exact journal entry that's in your books beforehand and you're using Excel to keep track of your books, instead of having to type out everything all over again, you can just copy those cells down. If I hit equals and click on cash, it'll bring the cash down that I want as my debit. And then because I know there's a common stock $1 par credit and a pick common credit underneath it, I can use the fill handle by going to the bottom right hand corner until it turns to a little black cross and dragging down. And that will tell Excel that I want the same two accounts that are underneath. And there, I got my same journal entry set up. So now on January 2nd, we're raising more money. How much money are we raising? Well, we're issuing 600,000 shares. We're doing so at a market price of $12. So 600,000 times 12 means that Cleanmore Appliance is raising $7.2 million in cash. Of that $7,200,000 that they are raising, what portion is attributable to par? We find that by multiplying the number of shares issued times the par value of those shares, which is still $1. So 600,000 shares at $1 par per share means that $600,000 out of that 7.2 million is attributable to the par value of our common shares. If we take the number of shares issued, 600,000, and multiply it by the difference between our issue price, our market price of 12, and our par price of 1, we come up with 6.6 million. We're issuing at $11 above par. $11 times 600,000 shares is $6.6 million of that 7.2 million that is above the par value of our issued shares or in excess of that par value. It is our pick. And we have $7.2 million of debits, $7.2 million of credits. We're good to go here. We issued more common shares above par, which I can copy that down by hitting equals and clicking on the text that I want to copy down. Next up, Cleanmore Appliance is going to issue bonds. So instead of selling more ownership of the company and diluting, if you will, the percentage of the company that every existing owner has, we can raise money in other ways. And we're going to raise money right here with debt. So we're going to go to the open market and say, hey, we want $2 million. Who wants to lend us $2 million? We're going to pay you a little something extra in form of this 8% interest for the for your end to make it worth your while to let us borrow this money. So Cleanmore Appliance is going to issue 8% 5-year bonds. These bonds have a face value of $2 million. However, we're not issuing them at face. We are issuing them at a bond price of 103, which means we're going to charge people that are buying these bonds from us, taking out, lending us money, 103% of the face value. These bonds are going to pay interest quarterly, and in addition to recording this journal entry, we need to account for that accounts for the issuance of the bonds. We're going to prepare the accompanying bond amortization table on another tab. Let's do the entry first. So on January 2nd, on 1/2, what's going to happen here? Well, first thing I know is we're getting cash. I mean, it's the whole purpose of taking on this debt is we want financing right now. And we're going to owe people money in the long run. We are going to have to repay that $2 million 5 years from now. That's going to be put in as a bonds payable. And we're only going to have to repay that $2 million. But I know that since we're charging a price greater than 100% of that face value, we're going to get more cash right now than we're going to have to repay in the long run. Not in counting interest, just the face value of the bonds. Because this number is greater than 100, I know for certain that I just somehow move that down. Excuse me. There we go. I know for certain that these bonds are being issued at a premium. So we're going to need a credit to premium on bonds payable. If they were below 100, then it would be a discount and it would be a debit to that account. And then lastly, we are going to have to account for that face value that we have to repay. So that goes into bonds payable. So for any bonds that are issued at a price above 100, if you're charging more than 100% of face value, that's your standard entry. Debit to cash, credit to premium on bonds payable, credit to bonds payable. The amount that goes to cash is found by taking the face value of the bonds and multiplying it by the bond price. Always remembering that the bond price, even though for some reason they don't put the percentage after the number, is always a percentage. So in this case, we are charging 103% of that $2 million. So let's take 2 million and multiply it by 1.03, 103% in decimal form. We come up with $2,060,000. So we're selling these bonds. We're going to raise $2,060,000 from the sale of these bonds. However, with your bonds, you only have to ever repay face value. So we're only liable to have to repay that $2 million in the future, which means we charged our bondholders above what they're going to get repaid. We charge them a premium that is the difference between the cash we are receiving and the amount we're going to have to repay. So click on it equals, click on the amount of cash you receive, subtract out the amount that you're going to have to repay, then what the bond's payable. We charge them an extra $60,000 of premium to buy these bonds from us, presumably because our interest rate of 8% is much better than you can get from other investors. But here, what is going on? It's making me do that. Here, we issued corporate bonds. And the thing says here that in addition to recording the entry, we need to prepare our accompanying bond amortization table, which you will find on the amortization table tab. There are different things in here. We're going to be financing with different forms of debt. The one that we want, though, is bond payable amortization table, which is the middle one on this template. Just make sure you're in the right spot. The amortization table for a bond always has 4 columns. Cash paid is the amount of interest that you are going to have to pay on that date. It's how bonds work. You agree to your bondholders that they're going to give you a chunk of money up front. You're going to pay them little periodic amounts of interest. And then at the end, you're going to repay them the full balance of face value of those bonds. The second one is interest expense. That's the amount of interest that you get to recognize on your books, which isn't always equal to the actual amount of cash that you are paying for that cash interest payment. I know it seems kind of weird, but what you're essentially doing is you're adjusting the amount of interest that is paid in the form of cash for the discount or premium that you had. So we need to amortize a premium. We need to get that premium off our books by the end of this bond's life, which the repayment date is going to be 12/31/27. We need to get that thing completely off our books, completely amortized by the time our bond is due. And then lastly, carrying amount is the value the bond will be carried for on our books. If you need something to put it in perspective for, think about it like that is how much we would have to reasonably pay if we wanted to pay off our bonds early today. The first date that we have is 1/2/23, which our journal entry, if I go back over, shows us was conveniently the date that we issued these bonds. The carrying amount, if we turned around on the same day, said, never mind, we wanted those bonds, I don't think our investors are going to be willing to take just the $2 million back. They paid a premium thinking they were going to get higher points of interest over 5 years. If they're not going to get it, they're going to want the full amount back. So you start with the amount equal to the cash that you received in the transaction. So our carrying amount in this case is going to be equal to that, if I click back over here, $2,060,000 of cash that we received. It's all you need for the first line because we're not paying anything on January 2nd. We're just putting the bonds on the books. We don't have to pay any interest yet. We pay quarterly, which means our first interest payment isn't due to our bondholders until the end of the first quarter, which should be March 31st. Time has not passed for us to amortize our premium, so we don't need that. All we have is carrying amount. Things are going to change over here when we are required to pay our first interest payment to our bondholders. How much are we going to have to pay them is a question you need to ask yourself when you're filling in the cash paid table. And you can find that by doing the standard interest formula for bonds, which is face, the face value of the bonds, times rate, the stated rate, times time. That rate is for the year. So these pay 8% every year, but we're not making an annual interest payment. We are paying quarterly, which means we're going to pay 1/4 of that each time. So to math that out, what we're going to do is we're going to take the $2 million. We're going to multiply it by 8%. And since it's a quarterly payment, we're going to multiply it one more time by 1/4. So I go back to my amortization table tab. I type in $2 million, the face value, times the stated rate, which we just saw was 8%, times 1/4, 1/4. and that comes out to $40,000. We're going to pay $40,000 on these bonds on March 31st, 2023 to our bond holders. Well, whenever we pay interest on a bond which is issued at a premium, in our case, or a discount, when you pay that interest is the same time you amortize that discount. There are several different methods to do this. The easiest one is straight line amortization, which is what I'm going to ask you to do. And all you do for that is you take the original amount of the premium or the discount that you put it on the books for at the time you issue. In our case, we had a premium of $60,000. And you divide that by the number of times that you will pay interest over the bond's life. These are 5-year bonds. They pay interest quarterly, which means 4 times per year. So if we're paying interest 4 times per year for 5 years, 4 times 5, 20 times. We're going to pay interest 20 times over the life of these bonds. So what I do now is I go back over and I'm going to take that $60,000 original balance of our premium and divide it by the 20 payments that we are going to make. And 60,000 divided by 20 is 3,000. So we know that when we're doing this, we're going to pay the amount, $40,000 in cash at the time. We're going to amortize $3,000 of our premium each time. For interest expense, how you find this depends on if you issued at a discount or if you issued at a premium. We issued at a premium. So the amount of interest expense that you're going to have can be found for bonds that are issued at a premium by taking the amount of cash you are paying and subtracting out the amount of premium that you're advertising. $37,000 is the amount of interest expense we're going to get to recognize on our books, on our income statement. It's going to compute into our taxes, all of that stuff. I subtracted only because it was a premium. If it's a discount, you do the opposite. So if you have a discount on your bonds payable, instead of interest expense being cash paid minus the amortization, it is cash paid plus the amortization. But since we have a premium, we are going to subtract it, recognize $37,000 of interest expense. Well, what about carrying amount? What is this? This is also dependent on if you have a premium or a discount. We have a premium. So if we issued it a premium, how you find your carrying amount after you pay is you take your last known carrying amount and you subtract out the amount of that premium that you amortized with that payment. Now we're down to $2,057,000, which makes sense. Again, carrying amount is what you would reasonably expect to pay to repay those bonds early if you had to. At this point in time, we gave them one big interest payment. So we're not going to give our bondholders back, if we want to get out of these bonds early, the full amount that they paid us originally. They got a little bit of that extra interest. We're going to pay them slightly less. So with a premium, your carrying amount should always be going down. For a discount, again, everything works the opposite. So if you're trying to figure out your carrying amount on a discount, what you do is you take your last known carrying amount and you add the premium to it. You repeat these steps over and over again. As we see, this is a very, very long line that we have going on here. I don't think anybody wants to go through and type. Thankfully, we have Excel and its handy fill handle. For cash paid, we have our formula typed it up here. You can see it in the formula bar. It's never going to change. For a bond, you pay the same amount of interest each and every time that you pay because the face value of that bond never changes. The stated rate of that bond never changes. And the time interval that you're paying, in our case quarterly, that never changes. Like all of your inputs in your formula are always going to be exactly the same. So to change, to fill in your cash paid column, I should say, all you need to do is just fill handle all the way down. It's going to be $40,000 each and every time. And we just fill all those in. For our discount being amortized, we're using straight line. The easiest way, it takes it off in a straight line in equal portions. If we take $3,000 away, 20 times the number of payments that we determine we're going to make, that's going to end up coming out to the $60,000 premium that we started at. So this is always the same. So we go and we fill handle that guy on down. And then we got some formula stuff here. Interest expense, when we did the formula, we said it was cell B21, which is the cell, the $40,000, minus cell D21, this $3,000 over here. Well, if I fill handle, it'll still copy that formula. So if I go and I bring this all down, all it does is it tells Excel to move down one line each time. We are, if you can see in the little numbers up there, that's 22. I click down here, it moves the formula to the 23s, the two numbers on the side, like everything's going to work out nicely for us. And that's important because we can use that same concept for our carrying amount. When we did this formula, we said take the cell above, which is cell E20, as we see in our thing, subtract out the cell next to it, cell D21, and you come up with your new carrying amount. So we take the cell above the number we're trying to fill in, subtract the amount from the cell to the left of it, and it gives us this. Well, we're going to want to repeat that same concept, right? For the June 30th, 2023 payment, we had $2,057,000 carrying amount. We want to subtract $3,000 out. If I fill handle, it's going to do that math for me. It takes out that $3,000. We're down to $2,054,000, and this is true the whole way down too. So with a properly set up table, you can go and fill in all of those numbers. When you copy with a fill handle, Excel brings the formatting of the cell that you're copying down with, which is fine, and I would never take off points for this, but it triggers me because in accounting policy, rules, and standard templating, if you will, you usually only put the dollar signs on the very first number in each column, and these all have them, and I don't like that. So what I can do is I can highlight all of them, go up to this section right here, and click on comma style, and it's going to leave all the commas and decimal points in, but it's going to get rid of those dollar signs, and now I don't have to look at that and be like, that's not the way it's supposed to look. All right, so everything's set up, but we're going to ask ourselves, are these numbers correct? And you can find those in several different ways, but the big one is right here. When you get to the bottom of bonds payable, assuming you're doing it for the entire life of the bond, which we are here because it's a 5-year bond and we're keeping track of all of 23, 24, 25, 26, and 27, we should have a carrying amount equal to face value at the end. And going back one more time over here, we absolutely do. We had a face value of $2 million. That's how we're going to get down to that $2 million on our books on December 31st, 2027, when we have to repay these bonds. They're going to be on our books for the exact amount, $2 million, that we are going to pay to our bond holders. Last step over here is to figure out our totals. I always type this in, it's just me. So if you hit equals sum, open a parenthesis by hitting Shift and 9 at the same time, highlight all the numbers you want to add together, and close that parenthesis, you come up with the total amount in that column. $800,000. We're going to have to pay $800,000 in interest over these 5 years for these bonds. We're not going to get to record a full interest expense of $800,000 though, because we were amortizing a bit of our premium. So I can fill handle in this spot. Again, it just copies the formula over. Now instead of the sum of column B, this fill handle said find the sum of column C. So we're good there as well. And I can even do this thing one more time. I'm going to bring it over here and we get 60,000. Do these numbers make sense? Absolutely. We're paying $800,000 in actual cash interest. Because we issued these at a premium, we're not going to get to recognize a full $800,000 of interest expense on our books. A portion of that $800,000 in actual cash that we're paying is going to be represented on our books as the amortization of our premium. But the amount of interest expense you actually recognize, plus, because this is a premium, the actual amount of premium you're amortizing should always add up to the amount of cash that you're paying. And in this case, it absolutely does. $740,000 plus $60,000 equals $800,000. And we're good to go on this table. Why would you bother doing this? Now you have this as reference. Every time we need to record a journal entry, I don't care what date it is, instead of having to go through and do the calculations and figure out everything that's happened in the past, you just bring this up on your computer and you have a reference. So if you're on, we'll say, random date here, if you're on December 31st, 2026, we're going to know, okay, we have to make a journal entry that's going to reduce our cash by $40,000, recognize interest expense of $37,000, and amortize a premium of $3,000. So now we're set up nice and easy to do all of our entries related to bonds.